So what happens when an industrial giant runs headfirst into a perfect storm? Do they just hunker down and wait for it to pass? Or do they tear up the playbook and start fresh? That's exactly what we're digging into today with Dow. We're going to unpack their incredibly tough fourth quarter of 2025 and their absolutely massive plan to not just survive, but totally transform. All right, let's jump right into the numbers.
Okay, let's just rip the Band-Aid off. The number that really sets the stage for this whole story? A staggering $1.5 billion net loss. That's with a B, for just one quarter. Yeah, this isn't just a little hiccup. This is a massive red flag, showing just how much pressure Dow is really under.
But, it's never that simple, is it? If you look closely here, there's a twist. Despite that huge loss, they actually beat expectations on earnings per share. So Wall Street was kind of braced for something even worse. But look at the revenue, a slight miss. And that's the key takeaway here, right? Even though they were managing costs pretty well, the money coming in the door was shrinking. They were still deep in the red.
All right, so what was causing all this pain? Let's dive into the headwinds that were battering Dow.
Well, the problem was basically everywhere. We're talking a 9% drop in net sales year over year. And this wasn't just one bad part of the company dragging everything else down. No, the slide was across every single one of their segments. Nobody was safe.
Let's take a look at their biggest division, packaging and specialty plastics. Sales there took an 11% hit, down to $4.7 billion. And the reason why is pretty simple. The prices they could get for their main products were just falling. It's tough to make money when the stuff you sell is worth less and less.
And you know what? It's pretty much the same story for their second biggest division, industrial intermediates and infrastructure. Another drop, this time 9%. The problem here? Just weak demand. Their industrial customers, think building and construction, were tightening their belts and just not buying as much.
So, with the storm raging, Dow knew they couldn't just stand there and get soaked. They had to act, and they had to act fast. It was time to batten down the hatches with some really aggressive moves.
And this right here, this is their survival playbook. They went right down the list. First, they found over $400 million in cost savings. Then, they made a really tough call. They cut their dividend by half. They also sliced $1 billion from their spending plans. And to top it all off, they sold off a piece of some assets for almost $3 billion in cash. By the end of the year, they were sitting on a solid $3.8 billion cash pile. Pretty decisive stuff.
Okay, but playing defense is only half the game, right? Dow wasn't just trying to survive, they were planning to attack. They announced this massive company-wide overhaul, and they gave it a powerful name, Transform to Outperform.
I mean, listen to their CEO, Jim Fitterling. He called it a comprehensive and radical simplification. Those aren't words you use for small changes. We're not talking about minor tweaks here. This was about a complete teardown and rebuild of how the company works, re-engineering its very DNA for a totally new era.
And the goal? It's huge. A $2 billion boost to earnings. Now, how are they going to get there? Well, as you can see, it's not all about growth. The lion's share, about 2/3 of it, is all about productivity, just becoming leaner and more efficient. The other third? That's where targeted growth comes in.
So, what's the secret sauce for all this efficiency? Technology. You guessed it. They're going all in on automation and AI to streamline everything on the inside and, maybe even more importantly, to completely reinvent how they deal with their customers.
But look, a transformation this big, it always comes with a human cost. And it's a significant one. The company announced they'd be cutting 4,500 jobs globally as part of all this.
And a move like that isn't cheap either. Dow is planning to spend somewhere between $1.1 and $1.5 billion just on the costs of making this happen. And a huge chunk of that, we're talking hundreds of millions, is going towards severance packages for the people losing their jobs.
Now, this whole overhaul wasn't just about what was happening inside the company today. It also meant they had to take a hard look at their big plans for the future, which led to a major delay for one of their flagship projects.
Yeah, I'm talking about the Path to Zero project up in Canada. This was a huge deal. They've now pushed its startup date back a full 2 years, from 2027 all the way to late 2029. The thinking is, why launch this massive new thing into a weak market? Let's wait for the recovery.
And of course, a delay like that has a direct impact on the money it's expected to make. They're now projecting returns in a much more conservative range, about 8 to 10%. It's just a reflection of this new, tougher market.
Now, it is really important to get this straight. This is a delay, not a cancellation. This project is not dead. They've already spent about 30% of the total budget on it. They are still 100% committed to it. They're just going to be a lot more patient.
Okay, so let's pull all these threads together. When you step back and look at the whole picture, what is Dow's actual blueprint for getting through this storm?
It really boils down to a two-pronged attack. Part 1, survive the short term. That means disciplined cost-cutting, saving every penny, and building up cash to ride out the storm. Part 2, reinvent for the long term. A radical overhaul designed to make them leaner, faster, and way more competitive when things turn around.
So you see, this is so much bigger than just getting through one bad year. Dow is hitting the reset button on its entire identity. They're changing their cost structure, their operating model, everything, because they know the future is not going to look like the past.
And that really leaves us with one big question, doesn't it? In a world that just seems to get more and more volatile, is this what we're going to see more of? Is this painful combination of deep cuts now, paired with a huge bet on future transformation, is this the new playbook for how industrial giants have to operate to stay on top?